Chris Gattis with Blue Point Strategies. And in this installment of the How-To series for the Women's Business Center of North Alabama, I'm going to talk about creating financial projections for your new business. So as we think about financial statements for a business, what do we really mean by that? Let's start with a few definitions. First, there's assets. What is an asset? Well, that's the stuff you own, equipment and inventory. You may have trucks, you may have some other kind of delivery vehicles, maybe it's manufacturing equipment, maybe it's inventory. If you're a retail store, you're probably going to have some kind of display shelving. If you're in a restaurant, you're going to have tables and chairs and cooking equipment, that sort of thing. That's assets. On the other side is liabilities. Liabilities is what you owe. You have bank loans, you have accounts payable, credit cards. Everybody has credit cards. We understand what that is. In your business, it works the same way. Okay, so the stuff you owe is your liabilities. Income is what you sell. Okay, if you're in a restaurant, it's how many plates of whatever you sold. If you're in the manufacturing business, it's how many of the widgets that you make that you sold. Okay, so I think you get that. Expenses are what it costs you to run your business and produce the products that you sell. Okay, and that's pretty self-explanatory too. The very last definition we want to talk about is cash flow, and that's very important for small business. Cash flow is how much cash do you have in the bank at the end of the day. And for a small business, one of the most important functions for you is for you, when you go to bed at night, that you know how much cash do you have in the bank, how much cash do you expect to collect over the next few days to a week, and what kind of expenses do you think you're going to have going out. So as you project what's going to happen the next week, the next several weeks, the next month, you have a pretty good idea of what's coming in and what's going out so that you can manage your business properly. So today we're going to talk about two primary financial statements, the income statement and the cash flow report. And it's important for you to remember that these financial statements are tools for you to use to better manage your business. Okay? You may have to produce them for a business plan, you may have to give them to your banker, but these are tools for you to run your business. Yeah, you're going to share them with other people, but if you don't understand what these things are telling you about your business, how will you know if you're making money? So it's important for you to remember that these are your tools. We're going to start with the income statement, and it has three major sections. Sales, how much you sold, whether it's a product or a service. What is the cost of sales? That is, what does it cost you to produce the products that you're going to sell? And operating expenses. What are the expenses of running your business on a weekly, monthly basis? So these expenses are typically arranged in a standard formula, and we're going to use this formula throughout the rest of this presentation. And the formula is this: we take our sales, what we sold, minus the cost of goods, that is the cost of producing the products, and when you subtract those, you get gross margin. You subtract from that the operating expenses, or what it costs you to run your business on a monthly, weekly basis, and then you get net income. And that's really it. The formula is very simple. When I teach workshops and talk to hopeful entrepreneurs, this is the thing they all get upset about, and they're concerned because they don't know how to do this if they're not a financial person or an accounting person. And it's really not difficult, okay? Anybody can do this. It's just adding and subtracting. There's no complicated math involved. So what I like to do is show people, what does this look like in a spreadsheet format? Because people are generally familiar with spreadsheets. The formula is the same. Net sales minus cost of goods equals gross margin minus operating expenses equals net income. What we're going to do is take the expenses associated with running our business and plug them into one of those two expense categories, that is cost of goods or operating expenses. So those two categories will be expanded slightly, but still it's the same formula. So what you're going to do when you run your business is you want to sit down with your partners, with some of your employees, with your spouse, whomever you use to talk about your business, and brainstorm what are the expenses associated with running a business like ours. It's not important that you get the numbers yet. It's the first step is to figure out what are those categories of expenses. You want to think about insurance and employee cost and building cost, acquiring the building. Do you have a deposit for your lease? Utilities, is there a deposit for the utilities? Your phone, advertising, business cards. Just brainstorm all of the possible expenses. And even if you end up saying, okay, that's not applicable to us later, that's okay. It's better to have too many than too few so that you don't get surprised when you're actually in operation and, oh, we forgot this huge category of expense, okay? So in today's example, what we're going to do is a little case study using Joe's Clean and Shine car wash. Okay, and Joe's is a typical tunnel style car wash where you drive up. The guys will use the brushes and whatnot to scrub the wheels and your windshield. You're going to drive through the tunnel, and when you come out the other end, they'll have towels and dry you off. So it's just sort of a standard tunnel car wash. And we're going to think about the expenses associated with that business as we go through building an income statement and a cash flow projection. Okay, let's get started. So what are the expenses associated with producing a product? Our cost of goods. Well, in our example, we don't really have a cost of goods per se, but we wash cars. So we want to think about what are the expenses associated in washing cars. Well, the first thing that comes to your mind is water, right? Then we have some labor to scrub the tires and the windshields and dry them off at the end, okay? So we have some labor. And that labor is different from the other kinds of labor that we'll use. And we only want to categorize this labor directly associated with producing the product in our cost of goods. We might have somebody that cuts the grass or who provides janitorial services, somebody who does bookkeeping. All those other kinds of labor costs are going to go in our operating expenses because they're not directly associated with producing the product. That's why this category of labor is typically referred to as direct labor. The third category in our example is going to be supplies, and that's things like soap and towels and brushes, sort of those general supplies that the people use while they're washing and drying the cars. As we look at operating expenses, what are those categories of expenses that typically would be associated with running a tunnel car wash? Well, you got rent. Obviously, you got either for the ground or for the building, or maybe a lease. You have utilities other than water, maybe electricity and cable, maybe gas, sewer, that kind of stuff. We have other kinds of labor other than the direct labor, so the bookkeeping and the cleaning up and whatnot, all that other labor would be categorized there. We have advertising. How are we going to promote our business? We're going to use TV, some other kind of media. We're going to do direct mail, social media. You know, what are we going to do? We got to figure those expenses. Insurance, we got workers' comp and hazard insurance and business liability insurance, okay? And telephone. So that's good enough for our example. You get the point. So we're going to use those categories of expenses in our example. And so the first thing we do is we're going to go back to our basic formula, which is net sales minus cost of goods equals gross margin minus operating expenses equals net income, and plug in these expense categories into that standard formula. And if you look at the spreadsheet example here, you'll see that. It's the exact same formula. We've just expanded the two expense categories to include these individual expense items that are going to be associated with running our business. The next thing we want to do is look at this statement in a whole year basis. Okay, so we want expense categories down the left and we want time across the top. And in our case, time is months. So we're going to have a column for each month, January, February, March, and so forth. So we're going to create this matrix with each column represents a month of expense. And now we get to the single hardest part of doing income statement projections, or from my point of view, the hardest part of doing a business plan in general is estimating what are your sales going to be. You've got to look at your market and what your model suggests, the way you're going to operate, who's your competition, who do you think your customers are, how does the market operate, what are the trends. All of these things have to be taken into account. And now you're a new player in this industry, in this local market. what piece of the pie, what share of the market will you get? If you're thinking big numbers, you better think again, because as a new player, you're going to have just a very small piece of the market. It's going to take a number of years for you to build your business up to the point where you have a big following and a big piece of the market. So now we have our matrix laid out. It's time to start plugging in figures. Okay, so we're going to start with, what is this net sales estimate that we're projecting? And then we're going to build the expenses below that based on the size of organization that's required to support sales of that level. So if we're going to say have wash 5 cars, we probably can do that with one guy, right? If you're going to wash 5 cars a day, doesn't take a whole lot of labor to do that. If you're going to wash 500 cars a day, you're going to need a lot more people, a lot more bodies to get that work done. So that's why everything starts with the sales. So let's look at our sales level and then come down and figure how much labor is required to support that level of sales. Our next category is water. How much water are we going to use if we wash that many cars? How many supplies are we going to need? How many brushes, how much soap, and so forth is it required to produce this much of our product, or in our case, provide this much service? You're going to go through and estimate these cost of goods, this cost of producing our product for each month based on what your sales figures are. After you finish with that, then come down and look at the operating expenses. What does it cost to run a business of this size on a monthly basis? The first category on our list is advertising. What's your advertising plan? What's your marketing plan for this business? And how do you expect to spend money to support the advertising needs of your new business? You're going to plug in the cost associated with doing that on the first line. The second one, I've thrown you a little curve. It's depreciation. Hold on to that. We'll come back to that line in a minute. Next is insurance. What are you going to plug in there for insurance? Well, if your insurance is going to cost you, say, $1,200 a year, then you're probably going to divide that by 12 months and spread that cost out. And this is what's known as accrual-based accounting. For most of you that have a small business with employees, you're going to use an accrual-based system. And an accrual-based system allows you to spread the actual cost out over a 1-year basis or over the time period that you're going to use the asset. If you're only going to use something for, say, half of the year, then you're going to spread it over that half of the year when you actually use it. You wouldn't spread it over the whole year. But insurance, you're going to use that constantly. So we're going to take that $1,200 and put $100 a month to spread that out over the term of year. So it reflects how we actually use that expense. Rent, your rent's going to be the same every month. You should know what that figure is. If you don't, how do you know? How much is it going to cost rent for your business? Well, you're probably going to have to talk with a realtor, maybe look at some different pieces of property, talk to the landlord. If I was to rent this property, what kind of costs are associated with it? And you want to look at the lease cost and the deposit cost and any other expenses associated with being a tenant in that building. And depending on the sophistication of the property, if this is a big commercial property, there's going to be some other expenses associated with it. You might have some common area charges where if there's a common area, the expenses associated with maintaining that are spread over the cost of all the tenants. Maybe it's snow removal, maybe it's a courtyard that has nice flowers and grass and whatever that has to be maintained. So these common area maintenance charges are something a lot of people forget about. So look at all the costs associated with that and talk to your realtor, talk to the landlord to get a good handle on that if you don't know. Labor, okay, now we're back to labor. Those people that aren't directly associated with producing the product, how many of them do you need and what do they cost? Telephone and utilities, I think you get the point. So you're going to go through your list for your business and figure out what is it going to cost you to run a business this size based on your net sales. All right, let's come back to depreciation. We skipped that originally. Depreciation is a second example. The first example was insurance, how we spread that out in accrual-based accounting. Depreciation is a second example of why the income statement is not real. It's a valuable tool to help you manage your business and indicate what kind of profitability you have. I'm not suggesting it's not valuable. It is extremely valuable. It's just not real. And some of you may struggle with that a little bit, but you'll see why that's important as we go through. So depreciation, let's talk about what that is. Depreciation is an accounting term based on the tax law that allows you to spread the cost out of big expensed items, big capital goods, in our case, say our tunnel for our car wash, over the useful life of that asset. Well, what does that mean? Okay, useful life is an accounting term that describes how long a particular asset is useful and over what period of time we will divide the cost of acquiring it. So let's look at a simple example of a laptop computer. If you have to buy a laptop computer for your business and you're going to depreciate that, you're going to say, well, what's the useful life? Maybe it's 2 or 3 years. So you divide the total cost of the asset by 24 or 36 months, whatever you and your accountant choose. And you're going to take 1/24 or 1/36 of that cost every month for that particular item. Okay? And for each of these big dollar asset items, you're going to do the same thing and add all of those up for each month, and that's your depreciation. In our case, in Joe's Clean and Shine Car Wash, we have this tunnel, and say it costs $300,000, and it's probably got a useful life, let's say, of 10 years. So we're going to divide the total cost of that asset by 120 months and take that amount each month. Well, why would you do that? Okay, just in practical terms, why would you want to do that? Well, if we had $300,000 expense in our first month of doing business, we got a problem, right? Because we're not going to make any money. It's going to totally skew our financial statements, not just for that month, but for the whole year. And so it's not going to be a very good indication of whether or not our business is profitable. So the accounting rules allow us to spread the cost of acquiring that asset over the useful life, and so that more adequately reflects how we're actually operating this business. Okay? And that's why this income statement is useful. That's why it's valuable as you look at, is this business making money on the basis that it operates? That is, if we use a lot of that asset, then we're gonna actually account for how much we used. But if it costs a lot and we're going to use a little bit of it each month, then we want to reflect that in our statement so that our income statement reflects the profitability of our business. While this is valuable to us, it also is another reason why this is not a real statement as opposed to cash flow, which is real. How much money do we have in the bank? So it's important for you to understand the difference. As a small business owner, one of your most important jobs is to know before you go to bed at night, how much cash do I have in the bank? What are the expenses coming up in the next week or month? And how much cash do I expect to be coming into my business over that same time period? If you don't know the answer to that, you're not doing your job as the business owner. It's very important that you understand this relationship between cash and your business operations. And as you go about doing your business, it's really imperative that you learn how what you do in the real world reflects in profitability from your income statement and cash in the bank for your cash flow. Those two relationships are very important for you to learn how those things interact and how what you do in the real world affects those. Is something that you will learn as you go along, and you really need to pay attention to that. So if we go back to our example company, Joe's Clean and Shine Car Wash, and let's look at the first year's income statement, and we see that we did a little better than $360,000 in sales. It's pretty good for a first year business. But if you go all the way to the bottom, you notice that we only made about $3,200 worth of net income. And as you think about Joe, the owner of this business, what does that mean for him? Well, it means he didn't make much money, right? Because Joe's not an employee, he's a business owner. So he only gets paid to the extent that we made profit and there's cash in the bank. So in terms of profit, the maximum Joe could make would be $3,248, and we haven't even paid taxes on that yet. Now, we're not going to get into the whole tax situation because that depends on the kind of entity, whether you're a corporation or an LLC or a sole proprietor, okay? It starts getting very complicated when you're looking at all these different scenarios. So we're just going to forget about taxes for this example. But you can't. depending on the kind of business that you select, you will have some kind of tax implication, and that needs to be figured in. So Joe's worked a whole year and only has the possibility of making $3,200. That's not too good, is it? Well, in the first year, maybe that's appropriate. So as we look at this whole first year statement, looking at the bottom line, the net income number for this first year, we notice that the first 4 months are negative. They're red, okay? So that stands out that we've got a problem there. Well, in the beginning, you're not going to have enough business to support all the expenses associated with just keeping the business going, probably. It's going to take some period of time before your business can support itself. So one of the reasons why we're doing this, so we know how much we have to have in the bank to support this business as we're getting started. You can also see that the last 2 months are negative, which means that our business is somewhat cyclical. That is that sales go up at certain parts of the year and they come down at other parts of the year. Joe's Clean and Shine Car Wash is located in the South, so that means that our sales are going to be highest in the warm months. Now, if we lived in, say, New England, that might be just the opposite. Because of the snow and the salt and the chemicals and all, you might wash your car more often in the cold months than in the warm months. So your projections need to reflect the way your business will operate, and everybody's will be different. So as we move forward, we're going to have smaller sales in the beginning, and hopefully that will ramp up over time. So what time period do we need to look at? Well, I recommend if you're beginning your business that you look at about 3 years to start with. 3 years on a monthly basis. Yes, when you get into year 2 and 3, there's a lot of guesstimating going on. I get that, okay? But you still need to make this projection so that you can have some sort of sense of what's really going to happen if my projections come true. Lots of things are going to come into play that cause your projections to be up or down from reality, but you want to assume that your projections come true, what's going to happen. And the only way to do that is to show these numbers moving out. If you don't like the answer, what do you do? Well, we're going to go back and look at our model. That is, how are we doing business? And we want to make some changes into the assumptions, whether we do something to market our business better, we do more advertising to get more sales coming in. What do we have to do to generate more business? The thing you don't want to do is say, oh, well, I'm going to make this number bigger, and so that way the numbers come out the way I want them to. Now I'm happy, right? Well, remember, this is a tool for you to use to manage your business, and if you're playing those kind of games with yourself so that you can try to make your banker happy, you're just shooting yourself in the foot. This is your business, and if you've put artificial numbers in here, yeah, maybe you've tricked your banker, but so what? You haven't helped yourself. If you end up going out of business and losing your life savings because you wanted your income statement projections to look good, you haven't really accomplished anything. So these need to be real projections based on what you honestly believe is going to happen, and they need to be fairly conservative. If you keep those sort of general guidelines in mind, you'll be okay. So we look at our first year's income statement. We reflect in this statement the whole year, and in the column next to that we have a percentage. Now, what's that percentage all about? Well, the percentage allows us to compare results from one year to the other when the basis is different. When I say basis, I'm referring to sales. So if you have small sales the first year and big sales the next year, it's hard to compare the actual expense number from one year to the next because the basis is so different. But you can compare them if you use the percentage. So in the first year versus the 10th year, you can compare the percents every year throughout. But in the actual numbers, that doesn't make sense. Now, if your sales are fairly flat for a period of time, yeah, you can compare the actual dollar amount of expense. But the percent allows you to compare those results with your business in different years, as well as with other businesses in your industry. And sometimes that might be important. For the cash flow report, we're going to use the same format that we were using in the income statement. That is, net sales minus cost of goods equals gross margin minus operating expenses equals net income. We're going to apply that same formula and just change some of the labels, okay, but the math stays the same. The one difference between those is we're going to pull out depreciation because it's not real. It's not cash, okay? It's this make-believe number, right? So we're going to pull that out, and we're not going to count that in our cash flow report. Cash flow is only going to include those items that are real hard cash. That is, it comes out of your bank account or goes into your bank account. So let's look at how the labels are going to be different. Our net sales is going to be turned into cash collected. Our gross margin is going to be turned into gross cash flow, and our net income is going to be turned into net cash flow. Other than that, the formula stays the same. Cash collected minus cost of goods equals gross cash flow minus operating expenses equals net cash flow. Okay, so what we're going to do now is just take each line month by month and determine how the cash flows for that particular item. Now in our business, at Joe's Clean and Shine Car Wash, we're a cash business. We take cash, we take credit cards, we take debit cards, which are all effectively cash. Yeah, there's a 2 or 3 day delay sometimes in the credit card payments, but effectively it's cash. So if we sell $100 worth of car washes in January, we collect $100 worth of revenue. That is, that $100 worth of sales gets deposited into our bank account in January. For your business, it may not work that way. You may have terms, that is, somebody buys a product from you and they have some period of time to pay you back, some kind of credit terms. Maybe they have 10 days, maybe they have 30 days. You have to figure that into the equation. If you've got some customers that pay cash and some customers on credit, then you're going to have to do a little spreadsheet work there to figure out how you expect the cash to be deposited into your account. And remember, just because you give somebody 30-day terms doesn't mean they're going to pay you in 30 days. Okay, you hope they will. They're supposed to. But it may be 35 days, it may be 40 days. You get the point. Okay, so you want to estimate how the cash actually comes into your account. After you've done the cash flow, now let's go down and look at the cost of goods categories. Labor is the first one. Okay, if you pay people every week or every other week, you can generally assume that any labor you use in a month is going to be paid in the same month. There might be some slight differences there. You know, it probably gets to be too fine a point to worry about. If you have some odd accounting for labor, some odd kind of payroll where it's delayed a month or whatever, then maybe you want to take that into account. But for most businesses, if you use labor in this month, you're going to pay for it in the month. Utilities, in our case water, is going to be the first one that, in our example, that we have a change. So if we use $100 of water in January, when do we pay the bill? Okay, when is that money coming out of our account and going to the vendor? Well, if you think about how it works at home, in a business it works the same way. You use $100, you get a bill about the end of the month, and you have 15 days or so to pay the bill, right? So if we use $100 in January, we write the check in February. So for this example, we're going to take everything in that row for water and just move it over a month, okay? Supplies, okay, we're going to figure how much supplies do we use, what kind of terms do we have, when do we write the check? Okay, and that's pretty simple. If you have cash terms, that is, you don't have credit terms, then when you take delivery of a box of goods, you write the check for it right then. If you have 10 days or 30 days from your vendor, then figure that into how you're going to actually pay this invoice line item. So now let's move on to our operating expenses. The first line item is going to be advertising. And if you look at this line item and compare it to the line item in our income statement, you'll notice there's a big difference there. Because we have some big expenses in the first month, which is probably reflective of some of our marketing collateral, maybe business cards and letterhead, that sort of thing. And then in the middle of the year, in June, we have a $3,000 expense. Well, it turns out Joe participates in this trade show in Las Vegas every year where all the big car wash guys go. And that's a pretty big expense item to get the booth and for the expenses associated with doing that show. So we're going to take that line item that we sort of spread out over the whole year the way we did with insurance, and now it's going to be reflected in how it's actually paid. So we're paying up front for some of this marketing collateral material. We pay in June for this big trade show we're going to, and so now this line item reflects how we're actually going to write the checks. Same thing for insurance. Remember we talked about insurance. If it costs $1,200 a year and we spread that out at $100 a month for our income statement, now we're going to reflect how that bill is actually paid. The insurance company is going to send you a bill twice a year where you're going to pay 6 months in advance probably. So our case now, instead of having a monthly figure spread out over the whole year, we have a lump sum in January and a lump sum in July. You're going to go through the rest of these line items and make this same determination. When do I write the check for this expense item? Labor for non-direct labor, non-related to producing our product, okay, is going to be worked the same way as our direct labor did. Rent is probably the same amount every month. Telephone and utilities, the utilities will work the same way that water did. Probably your telephone will work the same way. What you have to do is go through each of these line items and determine how does that expense work for your business and reflect it in the proper month for when you actually write the check for that line item. After you've completed that, you want to do the math, okay? You want to do the addition and subtraction and figure how much cash you collected minus how much your operating expenses and your cost of goods were, and what does that leave you in terms of net cash flow. And if you look across the bottom, you'll see some black numbers and some red numbers, just like is in our income statement. But the difference is that these numbers reflect the balance in your bank account, okay? And so we want to look at a cumulative, that is a running balance in our checking account month to month to month. So we're going to add that cumulative line, the one addition to this statement. And if you look at that, you'll see that as we lose money from a cash flow standpoint, that balance continues to go down. And then at some point, as we start making profit, the cash flow balance starts to come back up. Okay, and this sort of down and up look to that cash flow is typical for most small businesses when they start. And in fact, you can do a chart of the cumulative cash flow month by month and get a pretty good indication of how much capital is going to be required to start your business. Well, how do you know that? Just by looking at the chart. Well, it's really easy. What's the lowest point on the chart? As you see in this chart, I have plotted the first year's cumulative cash flow, and you see it has that same sort of down and up curve to it. And if you look at the lowest point on the chart, that tells you if everything happens exactly like you think it will, how much cash do we need? In this case, $15,348. If we have that much cash or credit in that amount, then we will break even if everything happens exactly like we hope it will. Is that going to happen? Not a chance. Should it happen close to that? Yeah, you hope so. You hope it happens almost exactly like that, but there's literally thousands of things that are going to happen that make that number be a little different than what you projected. But this will give you a really good indication of how long does it take this business to turn around and generate a positive cash flow. How much cash is required to support the business until it turns. Okay, those two things are very important for you. And again, we're going to look at how long a time period do we look. You want to look over the same time period that you're generating income statements. If you've done 3 years worth of income statements and then you've done 3 years of cash flow and you're still in the red after 3 years, then you need to expand it out a couple of years. Or more importantly, maybe you need to go back and look at your model and say, something about this isn't working. I need to change something about my model, not tweak my numbers, but change my model so that I get different results. It may be that nothing you do has a positive enough impact on this statement to make it viable. Maybe it's just not within the amount of resources that you have or can get to make this business work. And if you learn that in this projection process, good for you. Okay, you're probably thinking, oh, I wanted to do this business and it's just not going to work. Well, wouldn't you rather know that it's not going to work now before you invested your life savings in this business and then figure out, uh-oh, this isn't going to work. I've lost all this money and I don't know what I'm going to do now. The business is going to be shut down. Everything I've invested in it's gone and I've got no way to get it back. That's why you do these projections now, so you can get a good handle on that. So you know that this business is going to have a good chance of making it. So what happens if you don't like the results? You keep tweaking your model, you do this iteration, you go back and look at how you're going to do business and can I change something about how I do business so that I get different results. If that doesn't work, then, or it doesn't give you the kind of results you need, then this model may not make sense. And every idea isn't a good business. What if your results don't meet your goals? Well, maybe your goals are unrealistic, or maybe this business just doesn't have enough oomph to it to get you where you need to be. So you need to take those things in consideration as you're starting your business and as you're making your plans. This is Chris Gattis of Blue Point Strategies, and this has been Creating Financial Projections in the Women's Business Center of North Alabama's How-To video series.
The Women's Business Center of North Alabama, WBCNA, is a nonprofit organization whose mission is to help women and men start and grow a business and generate economic growth for the region. This is accomplished by serving as the premier source for information and access to resources, facilitating their self-discovery and personal development, and providing a mentoring process to support, nurture, and advocate the development of their business. WBCNA's services include startup assistance and nurturing, access to reduced rate services, access to financing, networking and business matchmaking opportunities, referrals to other resources, counseling and formal mentoring, executive level coaching, and business advisory boards. Specialized services of the WBCNA include the Government Procurement Assistance Center and the Veterans Business Assistance Center. For more information about WBCNA, please visit our website, wbcna.org. Get personal, create success.